Ladies and gentlemen, tonight we dive into one of the most talked about questions in global currency speculation. Which currency will revalue first? Iraq's dinar or Vietnam's dong? For years, investors, economists, and everyday people holding these currencies have debated the possibilities, trading rumors and predictions across forums, financial circles, and marketplaces. But behind the speculation lies a complex reality, shaped by oil, trade, policy, and global finance. Let us start with Iraq. The Iraqi dinar has long been at the center of speculation about a possible revaluation. Iraq is a country rich in natural resources, sitting on one of the largest oil reserves in the world. Oil is the backbone of its economy, accounting for more than 90% of government revenue. With such wealth underground, many ask, why does the dinar remain weak? Why is it that a country so resource-rich has a currency that struggles against the dollar? The answer lies in decades of war, sanctions, corruption, and political instability. Each time Iraq makes progress, fresh challenges arise, from power struggles within Baghdad to tensions with Erbil, and from regional conflicts to global oil price swings. The central bank of Iraq has tried to control supply, tighten markets, and stabilize reserves, but confidence in the dinar remains fragile. Now, let us turn to Vietnam. The dong tells a very different story. Unlike Iraq, Vietnam has built its economy on manufacturing, exports, and steady growth. From textiles to electronics, Vietnam has positioned itself as one of Asia's fastest-growing economies, often referred to as a rising tiger. The dong, however, remains undervalued, largely because the government deliberately manages it that way. By keeping its currency weak, Vietnam makes its exports more competitive on the global market, fueling trade surpluses and attracting investment. Some analysts argue that this undervaluation could one day lead to a correction, a revaluation upward. But others say Vietnam has no incentive to change a system that works to its advantage. So here lies the great contrast. Iraq's dinar is weak because of instability and policy struggles, while Vietnam's dong is weak by design, a tool for growth and competitiveness. And this difference shapes the debate about which will move first. Speculators point to Iraq, saying that its oil wealth, if properly managed, could support a much stronger dinar. They argue that once Iraq stabilizes, a dramatic revaluation could occur, lifting the dinar to new heights. On the other hand, those looking at Vietnam point to its consistent growth, rising foreign investment, and stable governance. They argue that the dong, while controlled, may one day be adjusted upward to reflect the country's true economic strength. But the question is not only about economics. It is about timing, policy decisions, and global conditions. Will Iraq's leadership muster the will to reform, cut corruption, and strengthen the dinar? Or will Vietnam's rising status in global trade push its leaders toward a gradual revaluation of the dong? As we set the stage for this comparison, one thing is clear. Both currencies carry potential but also risk. For the millions watching exchange rates, buying small stacks of dinars or dong, and hoping for the future, this debate is more than theory. It is about the possibility of life-changing returns or the risk of disappointment. Tonight, we will dig deeper into this comparison, exploring not just the economic foundations of Iraq and Vietnam, but also the politics, the strategies, and the global pressures that could decide which currency moves first, if either moves at all. Ladies and gentlemen, now that we've set the stage, let us go deeper into this fascinating comparison between Iraq's dinar and Vietnam's dong. At first glance, the two nations seem worlds apart, one struggling with political turmoil, the other rising as a manufacturing powerhouse. But beneath the surface, both currencies are bound by a common thread: speculation about when, or if, they might revalue. Let's begin with Iraq. The Iraqi dinar's value today is not a reflection of Iraq's potential, but of its challenges. The central bank of Iraq continues to manage supply tightly, sometimes cutting circulation, sometimes releasing dollars to the market in a bid to stabilize the exchange rate. Yet the black market often tells a different story. Prices in Baghdad, Basra, and Erbil fluctuate, often far above the official rate, creating frustration for businesses and families. Oil revenues continue to pour into Iraq, and reserves remain significant, but corruption and inefficiency drain the benefits. Investors who hold dinar argue that Iraq's vast oil wealth, second only to a handful of nations, could one day justify a much stronger currency. They imagine a scenario where Iraq revalues dramatically, overnight, shifting the dinar closer to parity with stronger currencies. But critics counter this view, saying Iraq's political instability, dependency on imports, and weak institutions make such a sharp revaluation highly unlikely. Instead, they suggest gradual reforms, slow adjustments, and the hope that, over time, stability will bring strength to the dinar. Now let us look at Vietnam. The dong operates under a very different philosophy. Vietnam has, for decades, deliberately kept its currency weak, pegging it within a controlled band against the US dollar. Why? Because a cheaper dong makes Vietnamese exports more competitive, and exports are the lifeline of Vietnam's growth. From Samsung smartphones to Nike shoes, Vietnam manufactures and ships goods to every corner of the world. By keeping the dong undervalued, Vietnam ensures foreign buyers keep coming back for low-cost production. This strategy has worked brilliantly, fueling years of steady GDP growth and making Vietnam one of Asia's rising stars. But here lies the twist. Many analysts believe the dong is artificially weak, and that in time, international pressure, especially from trading partners like the United States, could force Vietnam to let its currency strengthen. Such a move would amount to a revaluation, though likely gradual, not sudden. So, which is more likely to revalue first? On one hand, Iraq's dinar carries the weight of potential. If the government stabilized, if corruption fell, if oil revenues were harnessed effectively, Iraq could support a stronger currency. But each of those ifs is a mountain to climb. Iraq has been promising reforms for decades, yet progress remains slow. On the other hand, Vietnam's dong is already backed by stability, growth, and rising global influence. It may not revalue in a dramatic overnight shock, but over time, the pressures of trade, investment, and international diplomacy could push it upward in a controlled, calculated way. Another factor to consider is the role of the United States. Both currencies are heavily influenced by U.S. policy. In Iraq, the dollar flows through the Federal Reserve and is tightly monitored. American restrictions on dollar transactions often trigger shortages in Iraq, pushing up the black market rate. Any future revaluation would require not only Iraqi will, but also American approval, since Iraq's reserves are held abroad and depend on Washington's cooperation. Vietnam, meanwhile, faces a different kind of U.S. influence. Washington has long accused Vietnam of currency manipulation, arguing that by keeping the dong artificially weak, Vietnam gains an unfair advantage in global trade. If this pressure continues, it may eventually force Hanoi to allow the dong to rise, effectively revaluing in response to global demands. And what about the culture of speculation itself? In Iraq, ordinary people, small investors abroad, and entire online communities speculate daily about the possibility of a massive dinar revaluation. Stories circulate of life-changing wealth if the dinar were suddenly repegged to a higher rate. This speculation fuels hope, but it also breeds misunderstanding, as many confuse currency adjustments with dreams of overnight riches. In Vietnam, speculation is less dramatic, but it exists among investors who believe that the dong's undervaluation cannot last forever. They see Vietnam's trade surpluses, rising foreign investment, and growing middle class as signs that the dong will eventually climb higher. Now, let us consider the broader context. Global economics. Both Iraq and Vietnam are tied to larger forces: oil markets, trade flows, regional politics, and the ever-present dominance of the US dollar. As long as the dollar remains strong, both the dinar and the dong remain under pressure. But the difference is this: Vietnam's government uses its currency policy as a tool for growth, while Iraq struggles to use its currency as a symbol of sovereignty. So, the question remains, which will revalue first? If we speak of a dramatic, life-changing revaluation, Iraq is the dream many hold on to, but the odds remain slim without deep reforms. If we speak of a gradual, controlled appreciation, Vietnam looks far more likely, supported by fundamentals and international pressure. In truth, The real answer may not be about which currency moves first, but about which nation can deliver trust to its people. Iraq's dinar will only rise when Iraq's government can deliver stability, transparency, and growth. Vietnam's dong will rise when its leaders decide the time has come to balance competitiveness with global diplomacy. And so, ladies and gentlemen, the story of the dinar and the dong is not just about exchange rates. It is about two nations, two paths, and two futures. Iraq holds wealth but struggles with instability. Vietnam holds stability but keeps its currency low on purpose. The world watches both. Investors speculate, and the question lingers. Will Iraq surprise the world with a bold move, or will Vietnam quietly let the dong rise, step by step? For now, the debate continues. But one truth remains. Both currencies, whether through revaluation or reform, carry the hopes of millions who dream of a stronger future.